In January, GameStop announced it was closing 470 stores. 4 months later, it bid $56 billion to buy eBay, a shrinking video game retailer, revenue down 35% since 2022, trying to swallow a company 5 times its size. That's Blockbuster making an offer for Netflix. Except this one actually happened. eBay's board rejected it in days. But here's what almost nobody noticed. This takeover was announced in advance in an SEC filing from January 7th. Ryan Cohen's new pay package, $35 billion, no salary, no bonus, and one condition buried in the math that made a mega takeover not just likely, mathematically required. On January 7th, GameStop's board handed Cohen stock options on 171 million shares. Strike price, $20.66. The package is split into 9 tranches, 9 locked doors. Think advent calendar, except behind every door is several billion dollars. And also, you might get nothing. Door 1 opens when GameStop hits a $20 billion market cap and $2 billion in cumulative EBITDA. Door 9, the one worth the full $35 billion, opens at a $100 billion market cap and $10 billion in earnings. Here's the number that turns this from a pay package into a prophecy. On the day it was announced, GameStop was worth $9.26 billion. The target wasn't 10% growth. It wasn't double. It was 10x. For a company whose core business is selling you $7 for a game you bought for $70. And the structure is all or nothing. No partial credit. Miss a door by $1, Cohen gets nothing from it. No salary to fall back on. Nothing vests just for showing up, which makes him possibly the only person at GameStop with less job security than the stores. The blueprint is Elon Musk's Tesla package, the most famous all-or-nothing comp plan in corporate history. Now ask the only question that matters. How does a $9 billion company that sells used video games in strip malls become a $100 billion company? Not by selling more games. The entire business has been shrinking for a decade. Over 1,000 stores closed in 2 years. There is exactly one road from $9 billion to $100 billion. You buy your way there. The board didn't give Cohen a salary. They gave him a hunting license. Watch the dates, because once you see them in order, the whole thing looks less like a strategy and more like a heist movie where the SEC filings are the planning montage. January 7th. The $35 billion package is announced. That same month, Cohen tells the Wall Street Journal he's looking for a big deal, something to scale GameStop beyond gaming. Nobody asks the obvious follow-up. Mid-January, 470 more stores marked for closure. The market reads it as a funeral. It was ballast going overboard. February 4th, 4 weeks after the pay package, GameStop quietly starts buying eBay. Not openly, through derivatives. Put-call pairs structured so the position builds without tripping disclosure rules. The financial equivalent of buying your neighbor's house 1 brick at a time so they don't notice. By spring, they control a 5% economic stake. eBay has no idea. May 3rd. Cohen sends a letter to eBay's chairman. $125 a share. $55.5 billion total. A 46% premium to where the stock traded the day GameStop started buying. eBay's board says no. Not credible. Not attractive. Which, coming from the world's largest marketplace for Beanie Babies, stung. And this is where most CEOs fold. Cohen raises. The stake climbs toward 9%. The antitrust waiting period clears in early June, which converts those paper derivatives into real, votable shares. And as of this week, his team is evaluating a tender offer. That means going around the board entirely, knocking on every eBay shareholder's door with one question. Do you want $125 a share? Or do you want to keep trusting the people who just turned it down on your behalf? That's not an acquisition anymore. That's a siege. So, why eBay? Why not a gaming company? Read Cohen's offer letter. It's public, filed with the SEC, and you find a number he is clearly losing sleep over. Last year, eBay spent $2.4 billion on sales and marketing. It gained 1 million net buyers, from 134 million to 135. That's roughly $2,400 in marketing per new customer, to sell them other people's old stuff. Cohen's pitch is brutal. I'll cut $2 billion in annual costs in year one. Half of it straight out of that marketing budget, because at some point, the ads are just charity for ad agencies. It's the same knife he used at GameStop, where he cut overhead nearly in half and turned a $381 million loss into a $418 million profit. At least, that's the company's own framing of it. Companies describing their own turnarounds are like people describing their own gym routines. Directionally true, but the strategic piece is the stores. The same stores everyone watched him close. The 1,600 that survived? In the letter, they're not game shops anymore. They're authentication hubs, physical intake points where eBay sellers verify trading cards, sneakers, vintage games, collectibles, the highest margin, fastest growing thing eBay does. For 30 years, GameStop's store network was the punchline. Cohen is trying to sell it as the one thing Amazon can't replicate: a front door. Now the part the cheerleaders skip. The math has a hole in it. The cash half of the offer is roughly $28 billion. GameStop has $9.4 billion in cash. The rest leans on a financing letter from TD Securities for up to $20 billion. And in banking, a highly confident letter means probably. You would not accept highly confident from a parachute company. The stock half has a different problem. Half the offer is paid in GameStop shares, a stock famous for moving 40% in a week because of a Reddit post. eBay shareholders would be trading a boring, profitable marketplace for confetti that changes value by the hour. The board said roughly that, politely. And hanging over all of it, the conflict of interest hiding in plain sight. A $56 billion acquisition, paid half in stock, instantly balloons GameStop's market cap toward the tranche targets in Cohen's package. The deal doesn't just grow the company. Mal fee. It pays the man proposing it. His defenders will say the targets need EBITDA too. You can't hit $10 billion in earnings with an acquisition alone. That's true. It's also true that nobody draws a $100 billion treasure map and then forgets where they buried it. So, look at those 470 closed stores one more time. Everyone saw a retailer dying. Cohen saw a balance sheet getting light enough to jump. If the siege works, the strip mall game store becomes a $100 billion commerce empire, and that January filing goes down as the cheapest spoiler in Wall Street history. If it fails, GameStop is still a shrinking retailer, just one that told everyone, in writing, exactly how big it needed to become. There's another company that pulled this exact move, used a dying legacy business as a shell to climb into a completely different industry. It worked. You probably used their product this week and have no idea they spent 80 years failing first. That's the next video.